Okay, so these two financial statements are very important, but they are only as good as their accuracy. Mistakes are always made. No one goes to work and never makes a mistake. So your choice as to how you've categorized some revenues and expenses and items to possibly assets and liabilities, you're going to make mistakes. You've got to review your categorizations periodically to make sure it's accurate. In QuickBooks, if you use the QuickBooks program, that's very easy. Go to your profit and loss statement, call it up on your computer screen, and just highlight the amount under salaries and benefits, or let's say travel. Travel is $10,000. You can't believe travel is $10,000. It's way too high for this year. Just hover over the amount, double click, and it zooms you in to what comprises that $10,000 total. Every transaction that comprises that $10,000 total, so that you can look at that and make sure that you didn't make a mistake. And if a number surprises you, there's probably a problem with it. So, and I'm not saying that you should just review the items that look a bit out of whack. You should review every one of them, particularly before you make any reports. Maybe the quarterly report to the WSSB. Review your transactions before you submit reports, and don't wait until the day before the report is due, because you might zoom in on some item and whoa, there is a mistake, but I don't know where it is or where it came from, or I have to talk to Joe and Joe's on vacation. So review your financial statements at least monthly, if not more often. So that's how you can quickly and easily review the accuracy of your reports on QuickBooks, but other accounting systems have good methods too. I think that reviewing general ledger is a wonderful thing. Your financial officer should be doing that once a month, reviewing the general ledger. The general ledger is a detailed presentation of every single entry, every single entry into every account in the financial records for that period. So the financial officer will review the general ledger for, let's say, 1/1 of 20 to 1/31 of 20. It shows everything. You'd think, oh man, that's going to take too long. No, it's not. It is usually, unless there are just a lot of errors, it's a very quick thing to do. And you're going to get used to going through that and find that it's going to improve your accuracy in your coding of transactions to certain accounts. And it's going to improve your speed on your financial statement review also. These two reports are interrelated, the balance sheet and the profit and loss, in that the profit and loss at the end of this period, let's just say it's a year, if you made $10,000 this period, that is going to increase your equity by $10,000. Okay? So there is an interrelationship between these two reports. You're going to see that this, let's say 2020 net profit of $10,000 is $10,000 now higher at the end, December 31 of 20. This number is $10,000 higher than it was on December 31 of 19. These two reports interrelate, and they have to balance. One other thing that I think is important as you're reviewing the accuracy of your financial statements and can be very helpful is to review comparative reports. That would be a comparative profit and loss report. Let's say you compare at the end of your fiscal year, you compare the end of 2021's profit, you compare 2021's profit and loss to 2020's profit and loss, and they present each other. All of the totals of all the accounts will be presented in two different columns here. You can see then if there appear to be any great errors. Well, why is my state grant revenue so much higher in 21 than 20? I thought it was the same. Maybe there was an error in your coding. Also, a comparison report for the snapshot in time of 12/31 of 19 to 12/31 of 20. So there will be two separate columns. You'll see all the 19 assets and liabilities, and the 20 assets and liabilities. You'll be able to see, oh, the checking account is up by $50,000. Why is that? Oh yeah, I know why that is. Just thinking through it helps you to think through and manage, to be able to compare numbers from previous periods. Comparison reports can also be very helpful when you're preparing your budget for the next year. You could compare 2018, have a 2018 column, a 2019, and a 2020. See the trends of various revenues and expenses, particularly expenses, and use that history to be able to project into the future. And now I'd like to talk about the two different bases of accounting. There's a cash basis of accounting and an accrual basis of accounting. You may have heard about those. Most of your entities are going to operate their financial records on a cash basis of accounting. That means that you record revenue when you receive it. That means you enter it on your books, that revenue when it's deposited in the bank, that's the date you record it. And you record expenses on the date that you write the check. Okay, that's the cash basis accounting. It's based on cash in, cash out. Those are the dates that you record something. It's all about cash. The accrual basis of accounting is, you might say, a little more accurate because you're going to record revenue and expenses when all the events necessary to measure those things are done. When you know that you have that you expect the revenue and you deserve the revenue, that's when you record it on your books. Such as, for an example, you have applied for and been awarded a grant, but you've not yet received the money. You record the grant in your financial records when you've been awarded it and that you know you're going to get it. So it may take 3 months, may take 6 months to get that revenue, but you record it when you've been awarded. Okay, that's the accrual basis. On an expense side, if you have, let's say, hired a contractor to pave your parking lot. The parking lot is paved, it's satisfactory, however, there's just a detail or two left to be done. Maybe the contractor just hasn't signed off on something, but you know that you owe this money. You're going to record that expense when all the events have happened, that you can measure it, that you've received the benefit from that, and you can measure it. You're going to record it on the books. You may not pay it for another 3 to 6 months. Maybe the contractor is really bad in billing you or something. An example of an accrual of an expense. Maybe a contractor built some new steps into your facility. He bid the job at $10,000. The job is done. It's satisfactory. He has not yet submitted a bill. He's very bad with billing. We know it's going to be $10,000. We've already ascertained that. You would accrue that on your books right now. You'd accrue that after he's completed with the job and you know it's satisfactory. Even if it takes him 6 months to give you the bill, you put it down as a liability, a $10,000 debt, and then you record it as an expense. So that's another example of an accrual basis accounting. So as I said, most of you are going to use cash basis accounting during your operations all year long, and your accountants may be possibly the only ones that make accrual entries when they come to do your audit to restate your financial statements more accurately on the accrual basis. So you really may not even participate in those entries to change your cash basis financial statements to accrual basis for audit purposes. Okay, there's one other financial statement that we want to address, and that is the budget to actual statement. That's a very important financial report to help you to manage. That compares what you expected to happen to what actually happened. And so that will present your profit and loss. We'll have a column basically on what you had budgeted for this period and what has actually happened, and a difference, sometimes a percentage difference. This is very useful to review during the year so that you can see, well, let's take for example in the food service department, they budgeted $50,000 in food costs and it's halfway through the year, but the food costs are already $30,000. So now they might need to amend with their menus. They might need to economize. They might need to use down on some of their stores. But that's transportation directors might well need to review their categories of expenses, budget to actual. Fuel costs can increase or decrease. If there's no room in your budget and fuel costs have dramatically increased, you may need to delay some purchase of a new piece of equipment. Make it up in another area. So you need to be watching those very carefully. The budget to actual report can help remind you if you're looking at it frequently. Let's say if an expense category such as fuel has dramatically increased, you may need to even go back to the state and ask for an amendment of that budget line item. So that's very important that you stay on top of those and ask timely for those amendments. Those amendments, I think, are called revisions, and those need to be submitted timely when you need to move or change those budget items. Another reason why the budget to actual report is very necessary and important and useful to you, you will use your budget to actual report to be able to complete your quarterly report to the WSSB. It has budget to actual information on it. So I hope that this information is good and it's useful to you. Mainly, I wanted for you to understand that financial statements are very necessary. They're necessary because you can't manage a facility well without good, accurate financial statements. Keep them. Keep in contact with your CPA and ask questions. Review their accuracy frequently. Use them to manage. Board members, ask questions. It's expected that you'll have questions from these reports, and that's your job. As you're reviewing your financial statements for accuracy, and you see things that seem out of whack, certainly go into the detail, talk with the people in charge. If you see that your food expense is out of line or something appears to be in that category that's not, particularly if it's material, talk with the person, communicate adequately. Communicate within your organizational chart. If you see something that appears out of line, go to the executive director. The executive director may then go to the food service director and say, this just doesn't appear well. But communication is key. Good communication between you, your managers, the people above you, and to other people in your facility. Make sure that you use the correct chain of command, but you can't have good financial statements. They can't be accurate unless you talk to all the people involved.